All right, everyone, welcome back to Money Show's virtual expo for accredited investors. We are pleased to welcome Thomas J. Hayes. He is the founder, chairman, and managing member of Great Hill Capital, a long-short equity manager based in New York City. Before starting his own firm, Mr. Hayes worked with the Cornwall Capital LP, one of the firms featured in The Big Short book and movie. On a weekly basis, he publishes his timely stock market commentary, hedge fund tips with Tom Hayes, videocast, and podcast. It has a wide following in the investment management, hedge fund, and media community. Thomas, thank you so much for being here. It's all yours, sir.
Thanks for having me and welcome everybody. I thought by way of starting, I'd share a little bit about my background, how I got started in the hedge fund business. The first fund I was with was called Bedford Oak Advisors. The principal was actually good friends with Warren Buffett. So I started with a value tilt for sure, and that's carried through all of these years. But it was a great experience, a great learning experience. The four seed investors started with Sam Zell, Mike Bloomberg, Dr. Phil Frost of Teva, and Sandy Weil. They each threw in 25 million. So we had an all-star cast and an all-star team, to say the least. I started on the analyst side, helping to co-manage the portfolio, generate investment ideas. And one of the unique experiences I had is we had a small cap company that was in a little bit of trouble in the portfolio. And the principal said, well, why don't you go in? I'll put you in as COO. And I want you to go in and sell off the non-core assets and use that cash to buy an asset management business. So I said, okay, I've never done that before. Let's give it a shot. So we generated the cash. We sold off a hardware business. We sold off some land. And over the next 6 months, I interviewed and went to see over 100 different asset management businesses. So I saw under the curtain, I saw their books, saw their strategies. And I really learned in the business what strategies worked, what strategies were durable, what strategies didn't work, et cetera. And a lot of that has shaped how I invest and how I think about things moving forward. So we're going to get right down to it. Thanks for joining. So we run a long-short equity strategy in separately managed account format for accredited investors and qualified institutions. And we've really developed a reputation over time for benefiting from sector, stock, and general market dislocations in periods of distress. That's how I got my start. You know, people call me when the market is in distress, when different sectors are in distress. And when I left Cornwall and went out on my own, I really didn't have a need to raise a lot of outside capital. I was happy managing our own money. But I had a friend who would call me every time something happened. I'd walk him through it. And finally, he was managing about $1 billion. He said, listen, I feel terrible. You walk me through all this stuff. Would you, just start, are you taking money yet? So I called a lawyer and got set up. And that's how it got started. And it kind of grew word of mouth from there. As Mike said, Hedge Fund Tips is where we post our free weekly market outlook and research notes on the market. And then Hedge Fund Tips with Tom Hayes is a podcast. It's actually ranked #2 in the hedge fund category by FeedSpot. So that's also every Thursday. You can find that at the website, or you can just say, Google it in your phone and it will come up. So, we have a very simple old-fashioned strategy. We make our money buying on weakness and selling on strength. I know that's not terribly popular these days. A lot of people like to chase on strength and then sell after the market's down 20%. Like you're seeing a lot of fear in the market right now, which we'll talk about. Our confidence is to step in when others are bailing. That's rooted in the deep research that we do and the premise that as price becomes more dislocated, the risk has actually come out. People think that the more a stock falls, the riskier it gets. And when you do the research and you actually know what you own, and we're going to go through a number of examples here, what you find is the lower the price becomes when you've done your research, the less risk is actually in the stock, but less in the stock in the business that you're buying, because you're buying it at cheaper prices, provided they have durable earnings. And that's why you'll see infrequently are we ever involved in IPOs or companies that have been around for 12 or 24 months. We like companies that we can analyze how have they performed through different cycles. Do they have a durable moat? Can they perform when the general economy is weak, when it's strong, et cetera? And by having 5 or 10 or 15 years of data, when the market or the sector or the stock or the company becomes dislocated and misappraised due to exogenous events, we can step in with confidence and we can step in with material size and sleep well at night, knowing exactly what we own, versus chasing and white knuckling, staring at screens all day, hoping it doesn't move a tick against us. That's not our strategy in any way. Most market participants see increased volatility as increased risk. We view it as increased opportunity, and we think we have some of that increased opportunity happening right now due to the geopolitical headwinds. So again, this is opinion, not advice. We're going to go through several special situations that we took major contrarian positions and the reasoning behind the play. We're also going to discuss how to adapt if and when the position moves against us in the near term after we've done our thorough analysis of fair value. So it's one thing to buy in the hole. It's another thing, what if it keeps moving against you? How do you respond to that? How do you view, have the facts changed, et cetera? And does it create an opportunity to increase the size of the position? How do we think about that? And finally, we'll talk about two special situations that we're presently, we presently believe have significant upside value over the next 12 to 24 months. That's probably what you're most here for. Take the great ideas and go to the bank with them, and we'll definitely deliver on that front. So we're going to talk about Phoenix companies, which we did during the financial crisis, a soybean short position, which is not our typical knitting, but the reasoning will be helpful in understanding how we think about things. Range resources, the general indices, and banks and energy during the COVID crisis, and what was our reasoning, and what were our public writings at the time. That's the beautiful thing about hedgefundtips.com. We'll often pick up clients because they'll follow our podcast and videocast for 3 months or 6 months or a year, and just see how accurate our estimates were. And when they're comfortable that, number one, they have a similar line of thinking as a partner, and number two, that we've been, largely correct. You don't get everything perfect. That's what gives them comfort. And you can also see all the written things on a weekly basis. So you can go back to certain weeks a year ago and say, well, what was he thinking then? And then take a look at the market, what actually happened. And I think you'll be pleased with that analysis. So this was one of my big positions with Bedford Oak when I was getting started in the hedge fund world. Phoenix Company was a life insurer. You probably don't know the name now, but those of you around remember it. It catered to affluent individuals through variable universal life and other life insurance products. And what happened, along with all the other financial institutions during the great financial crisis, as a result of FAS 157, which played a huge role in creating the financial crisis, they changed the accounting rules. They went into effect in early 2007, which forced financial companies to mark their assets, even if they were paying, if it was a bond or whatever, if it was current on pay, but dislocated in the market due to illiquidity, they had to take the mark to market. And that impacted their earnings. It forced them to raise capital into a weak market. And effectively, it made the financial crisis a lot worse than it was. In April of 2009, the FASB ruled that they were going to ease this up. So no longer were you going to have to mark if it was paying and you intended to hold to maturity. By this time, Phoenix Companies was down 96%. The stock, I think it was around 49 or 50 cents. And we saw this as an opportunity. We started doing like, what's going to happen on the next earnings call? Because they could do it voluntarily in Q1 or on a mandatory basis in Q2. And our thought was, what CFO would wait an extra quarter to bring back all that earnings power? To give you an idea, they had taken a huge loss in Q4. They were down like $700 something million in Q4 of 2008 versus earning about 48 million in the same quarter of 2007. So we knew, and there were one-time costs involved in that huge drawdown in Q4, but we knew once this accounting change was happened, they were going to be able to take all of those assets, the marks, back up to par, which would actually come back as earnings power on their balance sheet. Sure enough, It was about 40 million positive to the upside. We had put on a large position in the 49-50 cent range. Within about a couple of months, the stock was up to over $2 per share, 205, and we started peeling out of that. It was eventually sold, but it was a quick, catalyst-driven, deep value. We were comfortable that the business was not going to go bankrupt. I even drove out to Hartford and met with investor relations. They had a beautiful building out there. For any of you who are in the insurance business, you remember that. But those are the type of things that we look for. It's dislocated. Is it going bankrupt? Why or why not? And then what's the catalyst to the upside, and what's a reasonable time expectation? Now, this one played out extremely fast in 90 days, but we would have been perfectly comfortable if it took 12 or 18 or 24 months as well. But the catalyst was imminent, so we could lean in size. Several years later, I actually sent an idea to Cornwall Capital. And for those of you who watched the movie The Big Short or read the book by Michael Lewis, they were one of the key protagonists. And I actually reported to the guy played by Brad Pitt. It doesn't look like Brad Pitt in person, but he's a lot smarter. He's one of the most brilliant guys you'll ever meet. And Ben was just a great contact there. So I send this over, and basically soybeans were at extreme prices. I wrote up my thesis and sent it over to Cornwall. I didn't know them at the time, but I thought, based on their thinking from reading the book, that they would appreciate this type of asymmetric idea. They were very obviously successful with the shorting the housing market. So at the time, there was a big drought in the Midwest. And when you looked at the weather patterns, you could literally go on weather.com and look out 3 months forward. There was not one drop of precipitation anticipated in the Midwest for a period of 90 days forward. I mean, that's what the outlook was. I took the under on that, not only because I thought that was extreme and they'd get some rain, but I also saw commercials were getting historically short into this parabolic move up, and I knew it was time to pounce. Now, what does that mean? Each week, they have something called the Commitments of Traders Report published by the CFTC, and that shows how large traders are positioned, small traders are positioned, and commercials are positioned. You always want to follow the commercials. They tend to be ahead of the curve. When they start selling aggressively as they're getting to extreme sold, the market is usually rising depending on the instrument, depending on the commodity or future. And when they've gotten really, really short, that tends to be the peak of that commodity, et cetera. And then you can get an inflection and a rollover. So you had the fundamental factors in play, you had the positioning in play, and soybeans actually pollinate in August. So this idea was in July of 2012. Soybeans had a longer time to receive rain than corn. Corn was a similar looking chart, but we were less interested because they didn't have that benefit. They could actually have the real drought and not get the outcome that soybeans could. Soybeans had more time to wait for a little bit of rain, and that's all they needed. The other thing we thought was that global politicians will not allow food riots or inflation in the face of monetary easing. So they would either raise margin requirements, which would help bring some of the froth out of the futures contract, or initiate farmer subsidies to incentivize farmers to plant more soybeans, and then the market would start to discount the future, et cetera. And this was very similar. Earlier in that year, we had put on a trade short orange juice, which was at an extreme level, I believe in February of that year. We thought it was unsustainable, and it rolled over in the same way. So this is what I'm talking about regarding the commitments of traders. This green line here are the commercials. And as you could see, when it gets to this level and they get that short, you usually do get a pullback. This was one of the most extreme levels. It got up here and it just rolled over. So Cornwall had put 1% of their portfolio in the idea. They were running about 500 million at the time. And that 5 million became 25 million in 90 days. Needless to say, we've been good friends ever since. They invited me to work with them, which I did for a couple of years before going out on my own. So that was another great experience. Okay, then in 2018, I put on something called range resources. Okay, natural gas, the theme. And by the way, just so you can have a visual, this is how brilliant I was. Okay, so we put it around on in the 11s and 12s range. It immediately shot up to 18. I thought I was brilliant. And then with COVID and other glut factors, it rolled over to $1.61 at the lows. So how do you deal with a situation like that? When you do a starter position, it starts to work. The good news is we didn't chase up at 18. We never chase up. We always buy weak. The bad news is it rolled over against us. So to put it in perspective, at year end 2013, the range resources market cap was 175% of its SEC reported 10 years of proven reserves. PV10 is what they call it. So it traded at a dramatic premium to its proven reserves. Now, at the time of our putting this position on, it was trading at only 41% of proven reserves. So it went from such an extreme premium over the reported reserves to such an extreme discount. And largely that was because of sentiment, because of people saying there was a huge glut in the Marcellus Shale. And other words, we had enough gas for 10 lifetimes. You couldn't convince the Europeans of that today, that's for sure. Although they are exporting more of the LNG now, and that's going to be a continued trend moving forward. The book value of the proved reserves alone was about $23 when we started initiating at 11 and 12 range. And so we knew that this was a double. It was a question of time. But the real opportunity, the embedded value, and why we leaned in aggressively at the lows is because the unproven reserves, which are the non-book reserves, they had another 2 decades worth of drilling. So effectively, what was $23 reported book was actually more like another $40 of unproved reserves, 2 decades worth of drilling. And we had estimated this thing could be worth as much as $40, $50, $60 plus. And it's not just that it would be worth $40, $50, $60. It's that how extreme would this get, this 175% of proven reserves get, once the sentiment changed, once the glut was worked out, once the export started increasing. You wouldn't continue to trade at 41% of $60 worth of value, which would be $24, which would be a double from our initial basis. You could trade as much as 100% or more above what we estimated to be about $50 worth of actual value, which could put the stock back up at $70, $90. What's interesting about this $11, $12 purchase is it wasn't, very optimistic. I mean, the stock was down some 90% when we initiated. So as it moved against us, and we continued to do more research. So what's changed? Are there any difference in the facts? And the answer was no. If anything, we thought the reserves were going to be worth more. We thought the demand was going to increase more. And we aggressively added down, actually bringing our basis down to $4.11. We still hold that position. I think today, at the time of this slide, it was at $24 or $25. A week ago, I think it's up to $27 now. And we would start peeling off some more of that in the low 40s and probably be inclined to hold it for some time. We think this is going to be a secular trend on the gas side, whereas the oil side could be potentially nearing a short-term peak, short-term pullback. So that's how we had the confidence. It moved against us. What had changed in terms of the facts? What had changed in terms of our analysis? And then leaning in really, really aggressive during COVID, getting that basis down. And now it's 6x plus. And we think this will be a 10 bagger plus, and maybe plus when all is said and done. So it gives you an idea of the difference between watching little ticks and understanding the assets and the business that you own, enabling you to lean in and get these. They don't give away 6 baggers and 10 baggers and 20 baggers for free. You have to know what you own and use any additional weakness to your advantage. The next one was during COVID in March 2020. Actually, on March 19th, I published an article on hedgefundtips.com, and you can look it up. It actually got picked up by MarketWatch. Sean Langlois has published the article. You can see it here, and you can also Google it on or search for it on Google. And basically, I compared because the Dow data goes all the way back to 1900. The S&P data is only post-World War II. And what I noticed was in the worst period of the Spanish flu in the early days in 1917, the drawdown was just over 33%, 33.5% on the Dow Jones Industrial. Whereas on that day, we had already been down 32.31% in the Dow Jones off of the fear of coronavirus. So we put out an article that we were aggressively interested in buying, and our famous saying, "Wall Street is the only place when they throw a clearance sale, no one shows up." And we were saying these type of things, and it was in print. And sure enough, the next day the market bottomed. Sometimes better to be lucky than to be good, but history doesn't repeat, but it does have a tendency to rhyme. And that was a huge, huge opportunity. Shortly thereafter, the Fed backstopped the corporate credit market, and it was off to the races. The other two trades we did during COVID, which were huge, nowadays everyone is calling for banks and energy. We were aggressively in banks and energy in the fall of 2020. We've been lightening up on both fronts in the last handful of weeks. We think that after they're up double and triple, we'll leave the last 10 cents. Someone else can pick that up in front of the bulldozer. But for now, we would need to see a more material pullback in both sectors to reload in a meaningful way. But the thesis was, look, the yield curve was steepening. This is the red and white line. This is what the green line is, financials. This is what happens to financials after the yield curve steepens. It's the beginning of a huge cycle. And we think this time's no different. The difference now is the yield curve's flattening. Today, it's about 20 basis points wide. So we think that potentially the Fed can re-steepen it with the balance sheet roll-off, and we can talk about that another time. So that was that. The other thing was the CECL, another accounting change which caused Wells Fargo to be dramatically undervalued during COVID. That was one of our largest positions. We leaned in aggressively, and our basis was 2501. And we said banks were over-reserved. Current expected credit loss, CECL, was put into place in 2020, which required banks to assume the worst case scenario for their credit losses and take all the reserves up front. So Wells Fargo was over-reserved by $20 billion because economists were saying we were going to have 20% unemployment and negative 9% GDP. The opposite is what happened. So those $20 billion came back as earnings, and the stock shot up. And early this year, it was in the high 50s, peeling off. We would consider reloading in the low 40s. If it gets there, it may not get there. ExxonMobil, this article was out on the Hedge Fund Tips website to the day. You could search on Hedge Fund Tips, quote unquote, "I'm an accountant," which was a play on a TikTok song. We try to have some fun with the articles. And we said, energy's the most shorted in 20 years. And we were pointing to the last time it was this shorted, and sure enough, they ripped. Exxon, we wanted to do high quality because of balance sheet, and the XLE we're positioning, and they've just taken off, and we're lightening up into the strength. Now, the big ideas for this year, Alibaba and biotech as a sector. Alibaba has been a controversial stock. Obviously, major value guys are in it. Bill Miller, Charlie Munger keeps doubling down on his double down on his double down, but he knows that these opportunities don't come around too quickly. I liken it to Microsoft from 2006 to 2013. Over these 7 years, the revenues grew by 112%, the cash flow grew by 193%, and the earnings grew by 120%. The stock price did zero. Now, over the next 7 years, the cash flow also tripled. Okay, so not much more improvement in terms of performance, but the stock went up 1,500%. So, it goes to show that even if you're early, if you've done a good enough job on the research, eventually you get paid in material ways for buying high quality businesses when they're on sale, provided the underlying fundamentals are continuing to improve. Alibaba is the same exact situation. In our view, in the last 7 years, from 2017 to 2021, the revenues grew by 900%, the cash flow grew by 550%, and the earnings grew by 600%. The stock price has done nothing. It's down to 100 today. In that range, you can buy it at 2014 prices. and yet get all of this growth effectively for free. So why is it down? The China crackdown. It's down because their growth rate is slowing. So rather than growing at 30% revenues, they're growing at, in the most recent quarter, in the midst of the regulatory crackdown, 10%. However, management did not take guidance down on the last quarter, which is very interesting, which implies their guidance was 20 to 23% revenue growth, that they're going to come through this crackdown just fine. And at 11 and a half times earnings, the margin of safety is huge, with a huge moat, 1.3 billion users worldwide, and a cloud business that's growing at the ratio historically that AWS was growing, and gaining a tremendous amount of share in Southeast Asia. So we like this story, and we think that it's one of the rare times that you can buy such a high quality business. And then when you look at the overall Hong Kong Shanghai index, it is on sale in a material way. The last time the rubber band got stretched this far, the Hang Seng relative to the world, I'm talking about the Hang Seng because it's China tech weighted, which is Alibaba as a major weight. It rebounded 156% over the next 17 months. That was in 1998. And then many of the individual stocks were up 200 to 250%. It shows Alibaba, the PE ratio falls to the lowest in history. It's at about 11 and a half times forward relative to its historic average of 28 times. And this is what I'm talking about. This is Hang Seng price to book ratio. This was the 1998, then during the great financial crisis, then I think 2016, and then recently. Every time that happened, you got a monster rebound when it traded at a discount to book, 156% rebound, 110% in 2008, 82% in 2016, and 35% in 2020. And during the periods that Alibaba was a public company, the last two periods, Alibaba's doubled the performance of the Hang Seng rebound. It rebounded 82% last time it traded below book. Alibaba rebounded 234%. And most recently, 2020, the Hang Seng rebounded 35%. Alibaba rebounded 70%. Biotech. Okay, this is taking the same type of drawdown as it did in 2016, largely on rate fears. It's trading with the innovation stocks. The difference is the valuation. These stocks aren't trading at an average of 40 times sales and going to 5 times sales like we've seen with some of the others. A quantitative study right now, based on its current multiples, going back to 1986, the sector would have to rise 24% to get back to its average price to book multiple, 155% to get back to its average price to operating cash flow multiple, and 112% to get back to its average forward PE multiple. We like that. There are over 100 companies trading at a discount to cash. We analyzed the top 30 weights in the biotech sector. Their earnings power since November for 2022 has been impaired by a 0.5% or so. In our most recent reading, we're redoing them now, but the sector's down close to 40%. We like that divergence. We think it's on rate fears. I think the narrative is going to change now with some of the things happening in the world to a slower growth narrative in the general economy, and these type of stocks are going to start to outperform once again. Everyone's crowded into cyclicals in the last few months after they're up double and triple and quadruple. We like buying things that are out of favor, dealing with the short-term volatility. And then when everyone's clamoring them, like people were for banks and energy in January and February, we help them out and we start to lighten up in a material way. Plus M&A, a lot of drugs are coming off patent. Pharma's got about 500 billion of cash on their balance sheets. They're going to be buying that innovation that's going to come from the biotech sector. We think that's a great catalyst. So, Mike, I'm going to turn it over for you. If you have a few questions we can handle before time runs out, I'm happy to do that. And I want to thank everyone for tuning in today.
All right, Tom, thank you so much. We had a viewer here. They're asking, despite the relatively rapid rise in energy and commodity stocks, do you think there's some upside over the next year or more also?
Yeah, I think, energy as a secular trend, I think what you're going to see happen, we'll get some resolution in the geopolitical issues. You'll get an Iran deal. You're going to start to see the rig counts up 164% off the pandemic lows. So the narrative's going to change. Everyone's chasing it up. I'd wait, it could push a little higher until the Russia-Ukraine thing starts to simmer down. But I'd wait for a meaningful pullback before you reload for kind of a 3 to 5 year cycle. I do think there has been underinvestment for the last 5 years. That was part of our initial thesis. But I just think that all the people that hated it in 2020 when we were pounding the table now love it. And that's the time you want to take some profits and revisit, see when they take the trapdoor out, when they all drop through the trapdoor in coming months, and you see WTI down 30, 40, maybe 20, $30 a barrel, and some of these stocks down 30%, and no one wants them and they're puking out because they levered up, then it might be some time to pick them up for the long term. As for banks, the yield curve's flattening. Some of them are looking attractive. I mean, Wells, I think, has come down, 10 points since we were sellers. Maybe another 8 points, we would reload on that stock because they're getting cheap again. But we need to also see the yield curve start to re-steepen, and that's a function of the Fed and some of these geopolitical issues starting to resolve.
All right, perfect. Time for just one more here. A few viewers were asking about Alibaba, and they're saying, are there political risks for them? And what would happen to the price if ever delisted from the NYSE?
Yeah, so the delisting is not a risk because you can, the ADS is fungible. So you could call your broker today and transfer it to Hong Kong shares, which we did several months ago. I think the ticker is 9988. And then you could always transfer them back. It's a nominal switching fee. So that's not really a factor. You could own it in Hong Kong that way. Is there political risk? No question about it. That's why the stock is down from $315 to $100. We think the vast majority of that is now priced in. There was kind of the final bit of bad news today that they're going to delay the IPO of Ant Financial, which is kind of priced in at this point. There's not much value attributable to it. If you back out the cash, I mean, this is, Bill Miller said it best last week. This is the cheapest large cap stock in the world right now. And we think a lot of those political risks are priced in. All of the regulatory announcements and crackdowns were largely a 2021 story. Now they're implementing them. And I think we're going to move forward, particularly because the China National Congress is happening in November, and Xi needs to juice the economy and juice the market in order to have that transition into his third term go smoothly. And they started stimulus about 4 months ago. That starts to be felt on a lagged basis, usually in about 4 to 6 months. So we're right on the cusp where we should see, as Ukraine eases up, China's numbers start to get better and better and better. And Alibaba, based on its weighting, is a key beneficiary of that.
All right, excellent. Well, everyone, we're speaking here with Tom Hayes, Great Hill Capitals. Tom, thank you so much for taking the time out today. It's greatly appreciated.
I appreciate it. Thanks for having me, Mike.